Hi and welcome to another edition of our weekly market outlook report. Global equity markets, currency markets and commodity markets are volatile yet again. Recently we had massive Fed QE intervention, which was then followed with yesterday's or overnight's White House and US Senators deal. They managed to strike a deal on a massive stimulus package of historic proportion. This is the rescue package worth $2 trillion in spending and tax breaks. Additionally, demand for physical gold is outstripping supply, and volatility in gold is very visible in derivatives, i.e. futures for gold market. Additionally, US dollar volatility is back on the cards as well, triggered initially by that Fed QE package, which is very visible in frequently traded currency pairs like euro dollar, dollar Japanese yen, and sterling dollar. Now, let's take a look at the market. This is Dow Jones or the Wall Street equity index, and we can see that yesterday we had this massive oversold bounce back. There was an initial trigger the day before with the Fed QE, and the news were trickling throughout the trading day yesterday that there is a very likelihood that Senate will go through with a deal and they'll find the way to agree and push this forward. And we had this massive oversold bounce back against this overall prevailing downtrend in the region of 11%. This is the best trading day for Dow Jones since 1933, over 11% up on a day. Now, where to from now? Be very careful because we are reaching some levels of resistance, although the positivity and optimism is there. The overall prevailing trend is still down. The current price is trading below 20, 50 and 200 period moving averages, and it's also capped by a falling resistance trend line pointing to a major level of resistance around that 20-day moving average, very close to 22,900 or 22,500 level. Now, if I go into a shorter term time frame and show you how this looks from the 4-hourly point of view, we are seeing this continuous selling pressure and consolidation, push lower, consolidation, push lower. Now we are coming to another level which could be possibly testing resistance, and that resistance was tested in the past on a number of occasions. So the current price action, this oversold bounce back that we saw, is initially capped by 21,357, which is the closing of this green candle here, followed by 21,600, which is the wick of the same candle as well. We can see that the oscillating indicator moved from oversold to overbought very quickly and a crossing over. We know that the prevailing trend is to the downside, therefore the bears are currently in charge. This is a bear market. If we see a corrective pullback into any of these three levels of support, so the initial downside support is at 20,300, 20,000, 19,700, so pullback into that level and a rally from there, or possibly a breakout of these current highs, a retest of that level from above as a newly found support that could open the way for an additional move higher and a spike towards additional resistances at 21,600, 21,900, 22,000, and then 22,500, 23,000 on the upside, and that will be basically a bullish breakout higher and a counter trend move higher. Alternatively, if the current prevailing trend stays intact and bears return, be very careful around this zone here, which is our initial downside support. So if we see a dip lower and the retest of this zone here, in particular the dip below 20,000 and the daily close below 20,000, retest of that level from underneath as a newly found resistance would negate this oversold bounce back as a major reversal, potentially opening the way for a deeper corrective move, therefore an extension to the downside, possibly retesting 19,000, 18,800 supports to the downside. Thank you for watching. Thank you for listening. Stay safe and happy trading. Bye for now.